Welcome to Accounting Modeling. In this video, I'm going to discuss about some important financial functions. As far as these financial functions are concerned, in your prior studies, you have learned all of these financial functions. Let's see what these financial functions are. First, we are going to looking at the two most important financial functions that is relating to the investment appraisal. When you are in the second year, under the management accounting course, you have learned about the theoretical aspects relating to the NPV calculation and also the internal rate of return. Also, you have applied these two techniques in a manual environment and worked out the investment appraisal. In the today's video, what we are going to do is we are going to learn how to apply these two most important functions relating to the investment appraisals in a computerized environment, especially using a spreadsheet package. When you are doing this under the second year management accounting course, there was a assumption that you have made use of. In the investment appraisal, you made one simple assumption, and that is when it comes to these cash flows, you assume that these cash flows either occur at the end of a particular period or it may be at the beginning of a particular period, and we call it the regular cash flows. So you have assumed the cash flows that it expect to generate from the investment is regular. It is either at the beginning of the period or at the end of the period. But however, when it comes to the spreadsheet package what you are using, the Excel, that will allow you to relax the particular assumption that you made. In that sense, even for the cash flows that may occur even in an irregular pattern, you can apply this NPV and IRR. So that is another kind of value addition. So you are going to do investment appraisal in the presence of irregular cash flows, or I would say in a more practical way. That is in the sense, when it comes to these cash flows, it is highly unlikely the cash flows to be occur either at the end or beginning of the period. So it is somewhat unrealistic assumption. But the practical scenario is the cash flows may occur during different times of a particular period. So we are going to bring that reality into the investment appraisal, and we are going to work out the NPV and IRR even in the presence of irregular cash flows. So that is the strength of the spreadsheet package what we are using. And then we'll be moving on to another financial function that is called the loan amortization schedule. So in this, you are going to compute the loan installment of a particular loan that you had obtained or that you are planning to obtain, and also to distinguish the interest component and the capital repayment component of this loan, thereby to prepare the loan amortization schedule for a period that you may decide as your loan maturity. So if you are obtaining a loan for a period of 5 years, we are going to looking at how this interest and the capital repayment would spread across this loan period. So that is what we take care of under the loan amortization schedule. Again, this should be something that you had learned in your prior studies. So especially when it comes to the financial management, you have discussed extensively about how to work out the loan installment and how to separate the interest from the capital repayment. So your prior knowledge may become applicable when we are discussing about the loan amortization schedule. Then we are going to take an application from the financial accounting. While you are in the first year, under the financial accounting subject, you have learned about the property, plant and equipment standard. In that, you have extensively discussed about the theoretical aspects behind the depreciation. So what is depreciation, and what would be the method that you can use for the depreciation. So likewise, you have discussed about uh, some of the theoretical aspects relating to the depreciation of property, plant and equipment. So here we are going to see, to do the depreciation of these PPE items, how we can use the spreadsheet package. Using the spreadsheet package, how to work out the depreciation, probably under different methods. So you can use the methods like straight line basis, and you can use the method like the sum of the year digit method, the reducing balance method. Likewise, there would be varying techniques. So we are going to have hands-on experience on these different depreciation methods. So therefore, the today's lecture would consolidate your knowledge on management accounting, financial management and financial accounting. Let's first move on to the NPV. The first we may try to apply the NPV for a regular cash flow scenario. So this is somewhat that you are familiar the most, especially while you are in the second year, you assuming the regular cash flows, you have worked out the net present value. So here, when you are going to do that using the spreadsheet package, so there we have a particular function which facilitates the computation of net present value. So here you can see the syntax. The NPV, there you have to identify two most important aspects. The first one is you need to identify what must be the discount rate. So you have to specify what is the discount rate. And then you need to identify what should be the cash flows. What are the expected cash flows of a particular project, particular investment, what would be the expected cash flows. And that is what we call the value. So it is quite straightforward. It says that the rate is the rate of discount over the length of one period. So your discount rate basically comes into play, and then the values. So the value 1, value 2. So these are 1 to 254 arguments representing the cash outflows and inflows. It is simply the cash flows. You can go up to 155 levels, but probably so at a single instance you can select all the cash flows of the project. So we may see that using an example. Here we have the first activity. It says that the following information is given for an investment. The initial cost of the investment is 10 million and the annual net cash inflows are given for 3 years. The project life is 3 years, year 1, year 2 and year 3. And also the discount rate is given to you as 15%. Now the requirement, find the net present value of the investment and also write a formula to display the appropriate decision based on NPV. So either to accept this project or to reject this project. So let me take this information to an Excel sheet and let's work this out. As usual, so we may be taking our inputs. Here we have our inputs of the model what we are planning to develop. So we need to have the, most importantly, the discount rate. Discount rate should be there. That is given 15%. Then we have the cash flows, especially the initial cash flows there. Initial cost. There we have rupees 10 million. Then the cash flows of year 1 to 3 is given. So the year 1 cash flow, it identifies to be 3 million, the cash inflow. The year 2, it is 4.2 million, and year 3 it is 6.8 million. So all the cash flows are there. So you can improve the readability by using the separators. Right. Now we are going to develop the model to identify the net present value. So if you take this output, so you may identify the period. You can identify the period 0, 1. So the fundamentals may come into play. You know, year 0 represent the beginning of the year 1, and year 1 represent the end of year 1. The 2 represent end of year 2, and 3 represent end of year 3. So it's a regular cash flow scenario. Then if you take the cash flows, you can take the cash flows. So it's like, you can simply make a reference. Year 1, year 2, or simply if you make the year 1, you could have dragged that rather than, right? So that is the easiest way. Then first I would say we may work this out manually, or the way you have used to do under the management accounting course. So we may try to work out without using formulas, without using the underlying function of net present value. We may work this out. So if you have to work this out manually, you know that you need to have the discount factor. You need to get the discount factor into the picture. So the discount factor goes like, in year 1, year 0, it is 1. In year 1, that must be 1 divided by 1 plus the discount rate. 1 plus the discount rate. So you can reduce that into 3 decimal places or 4 decimal places. So if you use the table, the discounting factor table, there you would see that into 4 decimal places. So let me keep it to 4 decimal places. Then you can simply drag this. So there it comes. 0.7561, 0.6575. So this is simply the applicable discount rate for the period. Applicable discount rate for the period are given. Now if you can take the discounted cash flow. Discounted cash flow. So it is simply, you can take cash flow multiplied by the discounting factor that provides you with the discounted cash flow. Then you may drag this. Then if you take the net present value, there it comes as, okay, take the simple summation, so that will provide you with the answer. So it comes around 255,609. So that is the net present value of this project. So depending on the cash flows that is provided, so you may change the things, and you can see that what if it is discounting rate of 10%. Yes, you can see. So this must be the case. So if it is 20%, this is it. So it's the project turned out to be a loss. So even you can change the initial cash flows. What if it is 20 million or something? So this should have been the scenario. And if it is like 15 million, and this must be the case. So likewise, you may try out different things once you identify the input and the output. So you can do this easily. So you have the ability to manipulate and see what is the impact that it has on the output. So it is the model flexibility. Model flexibility. Now, without putting much effort, with the help of the NPV function that is provided in your spreadsheet package, you would be able to easily work out this net present value. Rather than taking these discounting factors and the discounted cash flows, straight away you would be able to identify the NPV. We'll see that, right? So we may copy this information. So we may refer that. So it's initial cash flow, it's 15 million. Then subsequent cash flows, it's 3 million. So let me restore the original scenario, make it 10 million. Yeah. So this must be the case. So we should be able to generate the same using the NPV function, right? So now let's see the application of the NPV function. So all what you have to do is identify a particular place for this NPV, and you make it that. So how you should take, you can go to the NPV, just type NPV. Then you can have the expanded form of this formula by clicking the FX. Then it asks you to enter the rate. So what is the rate? That is the discount rate provided. So take it, make it constant. Then you have to give the values. So here, when you are giving the values, you need to be conscious. You need to be more conscious. So this is especially an area that things can go wrong with you. Let's first select all the cash flows and see whether it gives us the required result, right? So let's try this. So I would go to the values, then I may select all the values. I would select all the values. And this is what I told you, that you need not to take the values separately. So all the values what you have, you can select them at once rather than going into value 1, value 2 or up to 254. There is no point of doing that. So at a stretch, In a single value, you can insert or you can select all the values there, right? Then you can say OK and see whether it gives you the required result. It gives you a result that is different from the result what we have obtained earlier. Now you can see the discrepancy is there. But we have applied the NPV. We have very correctly applied the NPV function. So nothing wrong with that. We have specified the rate and the values. Here, this is an important point that you need to remember, that when you are going to apply this NPV function, you should not select the year zero cash flow. Normally, when it comes to this NPV function, how it will read these cash flows, they would even consider the year zero cash flow as a year end cash flow. So they would take it as a year one cash flow. So therefore, the year one cash flow as 2, year 2 1 as 3, and 3 as 4. So that is in a way kind of limitation in this NPV function. But you can simply get this across. You can resolve this problem. All what you have to do is, when you are specifying the cash flows, you are not going to take the year zero cash flow. You're not going to take the year zero cash flows, and we are treating it separately. When you are specifying the values over here, make sure to take the cash flows from year 1 to the remaining years. Then it would consider it as year 1, at the end of year 1 cash flow, 2 cash flow, and 3 cash flow, and it may bring the present value over there, right? Accordingly, when it comes to these values, I might change it, or I might select the year 1 cash flow onwards. Year 1 cash flow onwards, right? Thereafter, you can go to this particular area and separately add the year 0 cash flow. So it's a minus cash flow. If you want to deduct that, so in fact it should be deducted. So therefore we have to take it as a plus year 0 cash flow, right? Then you can say OK and see the result. Yes, you have got into the same result what you had observed while you are working that in a manual way, right? තර මෙතනදී අවධාරණය කරන්න ඕනේ වැදගත් කාරණාවක් තියෙනවා. මේ NPV ගණනය කිරීමේදී විශේෂයෙන්ම අපි ෆන්ක්ෂන් එක භාවිතා කරලා NPV ෆන්ක්ෂන් එක භාවිතා කරලා මේක කම්පියුට් කරනවා නම් එතනදී අපි සැලකිලිමත් වෙන්න ඕනේ මේ වැලිඩ් සිලෙක්ට් කිරීමේදී. අපි රේට් එක අඳුන ගන්න පුළුවන්. ඊට පස්සේ අපි මේ වැලිඩ්ස් හඳුනා ගැනීමේදී year 0 cash flow එක මෙතන හඳුනාගන්නේ නැහැ. මොකද මේ ෆන්ක්ෂන් එක රීඩ් කරන්නේ ඒ අපි ඉන්සර්ට් කරන සෑම cash flow එකක්ම කාලච්ඡේදයේ අවසානයේ සිද්ධ වෙන cash flow එකක්. එතකොට මේ year 0 cash flow එකත් අපි සිලෙක්ට් කරොත් වෙන්නේ ඒක හඳුනා ගන්නවා මේ ෆන්ක්ෂන් එක විසින් first year end එකේ cash flow එක. එතකොට year 1 එක මෙතන තියෙන year 2 end එක, 3 end එක, 4 end එක, ඒ විදිහට තමයි සිස්ටම් එක අඳුනා ගන්න. ඒ විදිහට තමයි මේ ෆන්ක්ෂන් එක හැදිලා තියෙන්නේ. ඒ නිසා අපිට මෙතනදී කරන්න වෙනවා යම් කිසි දෙයක්. අපි මේ year 0 cash flow එක අතහැරලා තමයි මේ values ටික specify කරන්නේ. එතනදී අපිට පුළුවන් year 1 end එකේ cash flow එකේ ඉඳලා ඉතුරු ටික select කරලා දෙන්න. ඊට පස්සේ අපිට පුළුවන් මේ ෆන්ක්ෂන් එක තියෙන තැනට ගිහිල්ලා එතනින් year 0 cash flow එක මේකට add කරන්න. එතකොට මෙතන අපි දන්නවා deduct වීමක් වෙන්න ඕනේ 10 million cash flow එක cash outflow එකක් තියෙන්නේ. නමුත් minus figure එකක් නිසා අපි ඒක addition එකක් විදිහට ගන්නවා. If you take it as addition, then you can say okay. Then you can get into the same figure. කලින් figure එකටම අපිට යන්න පුළුවන් වුණා. So if you remove the decimal places, Yes, that is exactly the same. Exactly same. You can even change the currency. So the currency, so in our case, that has to be the LKR. You can select it, our currency, if needed, then you can take it. So it is LKR 255 609.44. So that is the NPV, right? Now you have seen how easy that you can work this out. Even when you are arranging these cash flows, so here I have arranged the cash flow in a vertical, in a horizontal way. So even if you wish, you can arrange the same cash flow in a vertical way. So if I am to make these cash flows constant, and let me make it, and then I may put that into vertical manner and would show you. Sorry, it's a mistake. So make it constant. So I have made all the cash flows constant. Now I might copy this. So using your knowledge on paste special, I can paste it, the rows into columns. So I can transpose it and see, this is it. Even you could have arranged the cash flows like this, right? Then if I am to get the NPV, again, no problem, you can go to the NPV function. But remember, you need to be a little conscious here. The rate, no problem, from the input you may specify. But when come to the values, you are not going to take the year 0 cash flow, but the year 1 cash flow onwards. Then you may add the year 0 cash flow separately and got into the same figures. This is it. So this is the expectation. You can either arrange the cash flows in horizontally, or you can arrange them vertically. So it's something up to you. So depending on the requirement, you may decide in which format that is to be put. So it generates the same answer. So this is how we deal with the regular cash flows. So we are pretty much used to that from your prior learnings. Now we may look at a capability that may go beyond or stretch beyond the manual way of doing. So it's about the irregular cash flows. So in fact, I haven't taken on this second aspect. There you've been asked to write a formula to display the appropriate decision based on NPV. So the accept reject decision, so we may complete that as well. Referring to the one that you have done, you can here take the decision. So as far as the decision is concerned, so using your prior knowledge on if, so here there's a particular condition, when it comes to the decision rule of NPV, if it is 0 or above, we would be accepting the project. Or if it is below 0, then we may not accept the project. So that is the simple rule behind this. So accordingly, if you apply that, you can take a simple if function. If your logical test is going to be whether this value is more than or equal 0. So if it is more than or equal 0, then you are going to say this project must be accepted. So the project should be accepted or accept, let's say, or otherwise that has to be rejected. Reject. Then you can see the project is accepted. Project should be accepted. Right. You take the decision based on that. So if you change these cash flows, especially if you go to this input and make it like 15 million. See what is the situation. It says that the project must be, it gives us a negative cash flow, thereby the project should be rejected. So the functions what you have applied works appropriately. Right, I have restored the previous scenario. That's it. Right, let's now move on to the irregular cash flows. NPV with irregular cash flows. Here it is quite easy. So compared to even the regular cash flows, this XNPV is quite easy. So there again you have to specify the rate. So that is in fact the discount rate, and also the values, the cash flows must be mentioned. And together with that, one important thing may come into the picture, and that is called the dates. You need to specify the dates over there. So when you have these cash flows, the corresponding dates of the cash flows may appear, and together with these values, you should specify what are the dates of the cash flow. Since in this particular function, you may specify the dates of the formulas as well, dates of the cash flows as well. You need not to do any kind of manual adjustment as we did in the case of NPV. It is simply because the system recognizes the dates. So therefore, all the cash flows would be brought into the very first date of the given project. So in the very first day, say that it is 1st of April 2020, you have a cash outflow. Then once you select all the cash flows and the dates, this particular function would read. So therefore, you have to bring all these cash flow to 1st of April 2020. So therefore, in this particular case, you need not to go for any manual adjustment as you did in the case of NPV. तर මෙතන විශේෂ දෙයක් තියෙනවා පුතාලා, මේ XNPV කියන ෆන්ක්ෂන් එක අපිට ෆැසිලිටේට් කරනවා irregular cash flows එකත් ඩීල් කරන්න. तर මේ irregular cash flows වලදී අපි දන්නවා cash flow එකත් එක්ක අපිට ඒ cash flow එක සිද්ධ වෙන dates දීලා තියෙන question එකකදී දකින්න හම්බ වෙනවා. तर අපි කලින් විදිහටම XNPV ගන්නවා, NPV ගත්ත විදිහටම rate එක specify කරන්න පුළුවන්. values ටික කියන්නේ cash flows ටික, dates කියන්නේ corresponding dates ටික. හැබැයි මෙතන එක advantage එකක් තියෙනවා අර NPV එකත් එක්ක සංසන්දනය කරලා බලපුවාම. මොකද NPV කී අපි දැක්කා එක limitation එකක් තමයි year 0 cash flow එක අපිට වෙනම තමයි formula එකට accommodate කරන්න වෙන්නේ. ඒක අපි වෙනම manually adjust කරන්න වෙනවා. මොකද year 0 cash flow එක read කරනවා year 1 එකේ end cash flow එකක් විදිහට. නමුත් XNPV කියන්නේ advanced function එකක්. එතනදී අපිට තියෙන sophistication එක තමයි dates ටිකත් අපි specify කරන නිසා මේ project එකේ පළවෙනි date එක අපි හිතමු මේ project එක පටන් ගන්නේ 2020 1/4/1 කියන එක. එහෙනම් අන්න එදාට cash outflow එකක් තියෙනවා. එහෙනම් ඒ දවස මේ project එකේ ආරම්භක දවස විදිහට සැලකනවා. එහෙම සැලකීමේ හැකියාවක් මේ XNPV function එකට තියෙනවා. එහෙනම් අපිට බොහොම ලේසියෙන් year 0 cash flow එකත් එකම මෙතන දෙන්න පුළුවන්. මොකද dates ටික හඳුනා ගන්න නිසා. ඒක තමයි අපිට මෙතන හම්බෙන එකම flexibility එක. Right? We'll see how to work out a question for this XNPV to deal with irregular cash flows. Here you are given a question. The following information is given for an investment. You make this investment, you plan to do this investment on 1st of January 2020. Then the cash flows are given, the net cash flow. Initially you may incur 10 million, then thereafter 2.75 million on 1st of March 2020, then October 30, 2021, 4.25 million, February 1st, 3.25, April 1st, 2.75. So you can see that these cash flows are quite irregular. And in fact, This may be the reality. In reality, the cash flows may occur in different points in time. So here we have taken that particular reality into the picture. Then we may see how to work this out using the XNPV. Let us copy this information to an Excel sheet and then we may apply it accordingly. Right, now you have taken the question, that is activity 2. Then we may take it to the model format and let's work this out. So you have the inputs. The input is there, inputs. The discount rate is there, most importantly. So it is 10% as given. And also the cash flows with the corresponding dates are given. So you may copy that. The cash flows with the corresponding dates are given. Now if you've been asked to compute, then you may need the output. So in this output area, yes, again you can have this input and copy that to the output area. And get the NPV as required. Get that. So let's see that NPV. So in this particular case, your job is pretty much easy. All what you have to do is take XNPV. Take XNPV. So go to this XNPV and take the expanded form. There it asks you to expand. There it asks you to enter the discount rate as usual. That is 10%. Then it asks what are the cash flows. So here, without making a distinction of year 0 and year 1, you need not to make any distinction. You may select all the cash flows. All the cash flows from the first cash flow to the last cash flow. So you may select all the cash flows. Then if you wish, you can make them constant. Even the dates. From the first date to the last day, then you may have to select them accordingly. So here it gives you the cash flows in the values and the corresponding dates. So once you give that, it says that this project is generating 913,819.67. Then if I ask you this particular value you get on which date as per the dates given. Here you have discounted all the cash flows. Then therefore you have brought these cash flows to 1st of January 2020. The very first date of the project. You have taken all these cash flows to year 0, or I would say in terms of date 1st of January 2020. This is what the net present value that you would observe. The net present value that you would observe. Then how you can assure? So how you can assure yourself? So in fact, in order to assure, what you can do is you can work this out manually. So it is still possible to work this out manually, but the only thing is it takes some additional time. So it will definitely take some additional time for you to work the things out. But we may, since this is the first activity, we may work this out and we may verify ourselves. In that, we may take this cash flows. That would be good enough. In order to work the things out manually, I might take them over here. You can have a better view. The cash flows, then you can take the period. So if you wish, you can put the dates. Yes, no problem. Let's take the dates as usual. Copy that. You can put it. Then you have to have the discounting factor. So that has to be there. Discounting factor. So what you can use, here you can take the 1st of January 2020. The discounting factor is, we know that is 1. Then you can take the discounted cash flow. Discounted cash flow can be taken. Cash flows. So thereafter you have 1st of March 2020. Right? You know that it should be 1 divided by 1 plus the discounting factor to the power, the applicable power. Right? So here, how do you take that? So a starting point is 1st of January 2020. Then the first cash inflow occur on 1st of March 2021. So how many periods exactly from 1st of January 20 to 1st of March 21? So it's like exactly 14 month. In 14 month, starting from 1st of January to 1st of January 2021, there you have 12 months, and then to March, February and March, another 2 months. So therefore you can take it like it is 1 plus the 2 divided by 12. 2 divided by 12. So this should be the case. If you put it equal, sorry, this is the power, right? This is the power what you take. Right? It's 1 plus 2 divided by 12. So it's going to be 1.167 roughly. So therefore, when I'm taking the discounting factor, it goes like 1 divided by 1 plus, sorry, 1 plus the discounting rate. In our case, that is 10%, 0.1 to the power, we have identified to the power exactly 1.167. So it seems that it is difficult for us to refer, so therefore we may simply have an approximation 1.167 roughly, right? 167 roughly, right? Now that is the case for the first year. Then you can take the next cash flow that occurs in from the starting point, like after 1 year and 30th October, in the sense 10 month has gone, no? So it's nearly November 1st. So it is one year, one complete year, and 10 month is completed, the cash flow occurs. So accordingly, if you try to identify the power, it's going to be 1 plus 10 divided by 12. So it is 1.833. So if I'm to take that, 1 divided by 1 plus the discounting rate to the power 1.833. So you can have it, it's like 0.839 roughly. Right. Then the next cash flow, it is from the first point, you can see that it is after 2 year and 1 month time the cash flow occurs. So it is like 2 years plus the 1 month, 2 years plus 1 month. So if you try to identify the power, it's going to be 1 divided by 12. So it's like this. It's 2.083. 2.083. So equally 1 divided by 1 plus 1, the discount rate, to the power 2.083. So it gives like this. And finally, the final cash flow occurs in 2 years and like 1st of April, January, February, March, April. It's like 3 months, no? Yeah. So it's 2 years plus 3 months. So it's like 2 plus the 3 divided by 12. It goes like this, 2.25. So we are taking that 1 divided by 1 to the 1.1 to the power 2.25. So that's what you are getting. Right. Now you can take the discounted cash flow. I might reduce the number of decimal places. It is quite difficult for us to read and see. Keep that to 4. And if you take the multiplication of the cash flows, you can get into the discounted cash flows. Right. So we may get kind of close approximation because there can be rounding differences. But just to show you that whatever the answer what we may get is correct both the expressions. Yes, you can see that. So here, once you work out manually, you are getting into roughly the same figures. It's almost 930,000, right? It's 930,819 and 913.272. So there's a slight difference of like 500 or something. Is quite negligible, and that is purely due to the rounding errors, right? So that's why you would see a difference. But all what we need to convince ourselves, once we apply this XNPV, whether we are getting the same, whether we are getting the correct answer. So this confirms. So once you apply the XNPV, it brings all the cash flows into the very first day of the project and gives you the NPV. So here we have witnessed that by working out manually, it confirms our position. Then if I go to the second requirement, it says that in addition to the above cash flows, if cash outlay of 500,000 is required on 10th of May 2020, calculate the NPV of the investment. Now you are given the original scenario. Now it asks us if there's another cash outflow that occurs in 10th of March 2020, how this particular NPV would change. So again, you can simply accommodate that by taking this scenario. Here, the one important thing that you need to ensure is you are placing the cash flow in the relevant place. This is in a order. You can see that 1st of January 2020, 1st of March 21. So likewise, this is in order. The only thing that you need to ensure that if you are to accommodate a new cash flow, you must first decide what is the appropriate place. Then deciding the appropriate place, if you place it there, that's it. So මෙතන අපිට මේ අලුතින් තියෙන cash flow එක අපිට කැමති තැනක place කරන්න බෑ. මොකද අපිට පේනවා මේක යම්කිසි order එකකට තියෙන්නේ. 1st of January 20 ඊට පස්සේ ඊළඟ cash flow එක මේ වගේ dates order එකට තමයි මේක sort වෙලා තියෙන්නේ. එහෙමනම් ඒ order එක අපි maintain කරන්න ඕනේ. ඒක disturb වුණොත් මේක වැඩ කරන්නේ නැහැ. එහෙනම් 1st of May 2020 500,000 අපි අදාළ තැනද හඳුනාගත්තොත් එතකොට අපිට එකක් you may have to shift cells down and you may accommodate the new one. It's about 10th of May 10th 2020. Yes, May 10th 2020. You have to apply the date format, the month. So when you are inserting that, I have taken the month first, then the day, then the year. So you have to do that in compliance with the date order that is appearing in your computer. So it's 10th May 2020. Now the cash flow, it's 500,000 cash outflow. Now we have placed it accordingly. You can simply work out the NPV now, net present value. You can see with the help of XNPV, you can easily get this. The rate, so in fact that is 10%. The values, all the values that is there in the situation you may consider, and most importantly you should specify the corresponding dates. So with that you can see it makes a difference. Your cash flow is turned around to be 430,507. It is simply because this cash flow occurs quite near the beginning of the period. So just after like 5 months time this cash flow occurs. So therefore, so it makes a huge impact. So the project value is 913,819 earlier. Now with this new cash outflow, the NPV value turned around to be 430,507. So it is simply because it occurs at the initial stage of the project. So therefore, if you discount this and take the present value, it would be roughly around 475,000 or something. So because the impact of discounting is quite less since it is happening more towards the beginning of the project. So it's about the application of XNPV. So that is how to deal with the irregular cash flows. Now let's look at the other technique that is commonly used to appraise the investment. That is called the IRR, internal rate of return, IRR. The internal rate of return of a project is simply the required rate of return that makes the NPV of the project equal to 0. You know that when come to this internal rate of return, so this is the rate at which your investment, your net present value of the investment becomes 0. Or otherwise, we call it, this is exactly the return that the project would generate, the return of a particular project. So here the simple decision rule, whether you are to accept or reject the project, it is simply if the internal rate of return, the IRR, is greater than the discount rate or your cost of capital, we call it accept the project. If the IRR is less than the discount rate or your cost of capital, it is the decision that you take to reject the project. So that is the simple decision criteria. So this IRR and NPV would go hand in hand. So if you witness that in NPV, there you have a kind of positive cash flow, the positive NPV, probably the IRR is greater than the cost of capital. The IRR is greater than the cost of capital. And if the NPV is a -1, below 0, then the IRR is below the discount rate. So if the NPV is 0, then the IRR is exactly similar to the discount rate. So the application of IRR is quite easy. All what you have to do is just specify the cash flows. Just show what are the cash flows of a project, then it may automatically compute the IRR. If you wish, you can make even a guess. So it is something optional, but if you wish, you can guess a IRR. But we may, most of the time we may not, we may simply specify the values, then it would gives us the IRR. We may work out this using a question. Here you are given the information of a particular investment. The initial cost is given, the annual net cash flows are given, and you've been asked to calculate the IRR for the investment. Okay, we may try this out. As usual, I would copy this information. So it's the application of IRR. So then you can get your inputs. The initial cost is there. $70 million. Then cash flows from year 1 to 5 is there. Cash flows from year 1 to 5 at the end of each year. In year 1 it's 12 million, year 2 it's 15 million, it's 18 million, then it is 21 million, then it is 26 million. Right, you have taken all the cash flows. Then let's improve the readability as well. Now you can take your output, or even you may copy all this information, and I would arrange it in a kind of horizontal vertical way. The year 0 cash flow, year 0 cash flow as well. It's make the reference. Here we would make the references. Then if we do a particular change, that should manifest, that should reflect in the output. So that's the flexibility it offers. Now all what you require is to get the IRR. So in order to get this IRR, what you have to do, so you can make use of the inbuilt formula IRR. You may get that, and the values must be given. So what are the values that you should take? So it is simply from year 0 to the rest. So it says that it is 8.66. So this is your NPV. You can identify that into 2 decimal places. This is it. Now let's convince ourselves whether this is the correct IRR. Then how you can do? You can work out NPV using this particular ratio. And if we get the NPV as 0, then we know that is exactly the correct IRR. So that is a way to verify yourself. You can take into the NPV. So it asks us the rate and give it as the IRR. Then the values. So be conscious from year 1 to year 5. Then come and add the year 0 cash flow and say okay. Yes, you can see that it becomes 0. It becomes 0, right? So then you know it is exactly the return. internal rate of return is exactly 8.66. So that is way to convince yourself. See how easy you can appraise this investment appraisal. So once you come up with the cash flows, then application of NPV or identification of NPV or IRR is just a matter of few clicks. Just a matter of few clicks. In no time, you can come up with the NPV and IRR. Similarly, in the context of irregular cash flows, you can apply this IRR as we did the NPV, the XNPV. Here we have X IRR. Here also, the most important thing what you may have to do is, the new addition is, you may have to specify the cash flows, and then most importantly, the dates of the cash flows, the corresponding dates of the cash flows should be highlighted. And if you wish, you can make a guess. So it is quite straightforward. We may try this out. The calculate the IRR for the cash flows given in the activity 2. Okay. So relating to activity 2, we may go and work out the IRR. So here we have the question, the activity 2 scenario. Then here I would identify the IRR. So how you can get that? So that should be in fact the X IRR, because the irregular cash flows is there in the given investment appraisal. So you would take X IRR. Now you can take the expanded form. So what must be the values? The value should be the cash flows. So you may carefully select the cash flows and the dates, that is in fact the corresponding dates. So this must be the case. The project generates a return of like 15.40. So that is the return what it generates. Then in the second instance, you have identified a new cash flow that is on 10th of May 2020. Relating to that, the new circumstance, you can work out the IRR. And we may work out IRR in that particular scenario as well. X IRR. The values are there and the corresponding dates should be there. Then it says that it generates roughly around 12.47. So similarly, you can convince yourself, you can work out the X IRR using this discount rate in the two instances, the given the applicable discount rate, and you can see whether the NPV becomes 0. NPV becomes 0. So how you should take it? It is simply the X NPV. So you may get the rate, it's 15.4. The values, here you have the values, and here you have the dates, and it is almost 0, 0.0833. So if you take it to kind of decimal, no decimal place scenario, it is 0, right? It's almost 0. So due to rounding errors, the small difference may appear, but it is almost 0, right? Then again in the new circumstance where you have added a cash outflow on 10th of May 2020, if you work out NPV using the new rate, you may witness the NPV becomes 0. So therefore you can verify yourself, whatever the IRR you got, that is exactly correct. The values, the corresponding dates. Sorry, it's not the XIRR, what we need, XNPV. No? XNPV must be taken. The rate, this is it. and the values. Here we have the values and the dates. This is it. And yes, again it is almost 0.04. It's almost. So if you take it to one decimal place, it is exactly 0. So therefore, you know how to apply this XIRR and IRR for a given scenario. Now let's move on to the presentation and let's look at an exam type scenario. An exam type scenario of this NPV application. So in your examination, you would likely to receive something like this, where you would be given some information as to the investment appraisal of a particular company. Here we have identified the initial investment and the test marketing cost is given, the selling price, the expected selling price inflation, the demand is given in year 1 and the expected demand growth has identified, the variable operating cost of year 1 and fixed operating cost also given, the expected variable operating cost inflation, capital allowance on the plant and the corporate tax rate payable in the year on which it accrues, the payable in the same year, scrap value, the 10% of the initial investment, there's a scrap value, and the cost of capital is given 15%, the project life is 5 years. You've been asked to evaluate the financial feasibility of the project using the net present value and internal rate of return. Now let's try to work out this particular case. So initially you can copy the information to an Excel sheet. Let me take a separate Excel sheet for that. And this is basically your inputs. This would serve as the input. This information, what is given there, that is simply the inputs of this. So you need to do some adjustments, the modifications. So we may do those applicable adjustments. Having done that, we can get into that. So here initial investment, let's remove this rupee value. Then the test marketing cost, again we may modify that. The selling price, so you can remove it. We are going to make the references. So 9% is enough per year. And demand, it's okay. Expected demand growth there. The variable operating cost, it is free from non-cash elements. That is the most important thing. That is something to be remembered. And it's 200. And it is fixed operating cost is given. Remove it. Then 6% per annum. 6% per annum removed. Capital allowance fine. The corporate tax rate, get rid from that. The 10% of the initial investment, the scrap, cost of capital fine, project life 5 years. Right, this is basically the inputs that it takes for the project appraisal. Here you have the comprehensive input. Then you need to get into the output. You need to get into the output. So how about the output? So here you need to plan your output. So when you do an investment appraisal, you start with the period. You start with the period. It is spanned from year 0 to year 5. So you may take it up until year 5. Right. Then starting from the investment, you can start with the investment. No? So that is generally what it does. The investment must be there. So if you have if you have the working capital requirement, That should also be taken, but here we do not have it. So then we can move on to the rest of the information. We can get the sales. Thereafter, operating cost. The variable operating cost can be taken. Variable operating cost. Then the fixed operating cost, similarly, you can take fixed operating cost. So then thereby you can work out the profit, and then you can calculate the income tax or corporate tax, we would say corporate tax. And as you have worked out in your management accounting courses, management accounting course in the second year, so in a question, if it involves that capital allowance is involved, you can have a saving on that. You can have a tax saving on capital allowance. So therefore, I might dedicate a column for tax savings on capital allowance. Capital allowance is, it's a non-cash item. The capital allowance, it is the tax depreciation. Then on that, but however it is tax deductible. You can deduct it for the purpose of tax computation. So therefore, what you can do, you can have a kind of saving on that. It's a cash inflow. Then again, you may have to consider about this, the disposal of the investment. So we call it, there must be a tax consequence there. The tax on gain or loss. There can be a gain or loss. Gain on disposal of investment. It's a plant or whatever, right? The plant. You can take it, you can identify that. So that is also important item. And these are the cash flows that you may have to consider. Thereafter, you can take the net cash flow. Net cash flow. So once you get into the net cash flows, you can identify the NPV. So also the IRR is requested. You can work out the both. So here I have simply set the format. Now the most important thing is identifying the cash flows. So here I haven't taken the test marketing cost. It is a irrelevant cash flow. So while you are learning in the second year management accounting, you have learned that the test marketing cost is a irrelevant cash flow. Therefore, that is not applicable. So that's why I purposely did that. I did not took that to the picture. Then the initial investment, you can make a reference. It is there. It's a cash outflow. Make sure to make it -1, and better make it constant. Yes. Then it says at the year 5, so there's a scrap value. Scrap value is 10% of the investment. So scrap value is a kind of inflow. So it expect to occur in year 5. It is relating to the investment. So you may identify the scrap over here. In year 5, you would take the initial investment that is multiplied by the scrap value, 10%. So we may improve the readability. So it's like here we have 120 million, then the scrap value is 12 million. Okay, now we may get into the sales. The sales is, the selling price is given, year 1, demand is given. You can simply take it as a multiplication. So we have done several questions of this nature, so you can easily identify that sales price multiplied by the demand. You may get into that. So it's 56.25 million. In year 2, you may have to consider about the growth. So you may have to accommodate the expected selling price inflation and the expected demand growth. So you know how to get that. You may refer to the year 1 sales multiplied by 1 plus the applicable growth rate in the selling price, then the applicable growth rate in demand. Okay, we have taken that. Sorry, it should be B8. So I made a wrong reference. Sorry for that. So it should be expected demand growth B8. B6 and B8, verify yourself. B6 is there, B8 is there. Yes, fine. So if you get it that correctly, you can enter that. So it's 64 million. Now you can simply drag it up to 5th year. So this is your sales. The corresponding sales are identified. You have accommodate the sales price growth as well as the demand growth. Now the variable operating cost, we'll see what is the situation. In year 1, it's going to be 200 into the demand. Thereafter, expected growth is there. Expected variable cost inflation is given 6%. 6%. You should consider that. In year 1, as usual, it's a -1. Make it minus 200 multiplied by, make it constant as well, multiplied by the demand. So it is 125. Get that. So it's 25 million. Then in year 2, you may get the year 1 scenario and accommodate the growth. The growth in the demand and the growth in the cost. Expected demand growth 5% and multiplied by 1 plus the growth in the expected variable operating cost growth. So consider both the inflation and you may get into that. Then you can simply drag it. Once you get into that, simply drag it. Then you may have the fixed operating cost. So as per the question, we have seen that it's free from non-cash elements. You can simply take the fixed operating cost. It is quite straightforward. No growth rate is applicable there for this fixed operating cost. Yes, you can easily accommodate that. It's like 1 million throughout the period. So make it constant. Then you can simply drag it. Now you have the cash flows. The sales are there. The variable operating cost is there. Fixed operating cost. So once you get the net amount here, so that is what we consider for the tax purpose. So you may deduct the cost from the revenue, and that profit is what we considered for the corporate tax purpose. Here we have purposely ignore the capital allowance. Later we may consider tax saving on that, right? Or otherwise what you could have done is you could have taken this as a working and also take this capital allowance and take the profit, the taxable profit, then compute the corporate tax at once. But I believe it takes more effort. So therefore the easiest way out, you may consider these cash items. Okay, these are the cash items. So considering that, you may compute the profit and thereby compute the tax. Then take the capital allowance separately. Since it's a deductible expense, compute the tax saving on that. So the corporate tax, you can take it like, you can simply take the summation of this. Having taken the summation, multiply this by the tax rate. Multiply this by the tax rate. So the corporate tax rate is 30% and you pay the tax in the year on which it accrues. So therefore, you take it to the same year and this is it. And make sure that since it's a tax, make it a minus figure. Right? This is it. You have considered the cash sales, variable operating cost and fixed operating cost, and thereby you compute. Right? You haven't considered this investment. The investment disposal you haven't considered yet. Only the sales, variable operating cost and fixed operating cost has been considered. Now the tax saving on capital allowance. So how do you compute the capital allowance? Just to show you, it is quite straightforward. You would take the investment in PPE, it's a plant, and multiply it by the given capital allowance. Capital allowance on plant is 20%. This is it. So per annum, you would depreciate it 24,000. So for the computation of taxable profit, you can deduct this capital allowance. So therefore, there's a saving since it's an expense. So this saving must be taken over here. Then how can you take that? Now you have to multiply this capital allowance by the corporate tax rate. Since it's a saving, take it in the positive form. Take it in the positive. So make sure that you make it constant as possible. Right? 7.2 million saving is there and it is stretched up to the 5th year. Now we are coming to another important thing. It's about the gain or loss on disposal of plant, and there you have to consider about the tax consequence. Here you have the disposal that is at the end of year 5. Now how you are supposed to compute this? It is quite straightforward. You may take the sales proceed. If you dispose this, how much you would get? So I'm just to show manually working that out. So the cash flow is from the disposal, you would get 12 million at the end of the period. No, it is 12 million. So this is the cash proceed. Then you need to see what is the carrying amount of this particular plant in line with the tax depreciation. Carrying amount of the plant. Carrying amount of the plant has to be considered, right? So how you should consider that? That is in line with the tax depreciation, right? Because this is for the tax purpose. So per annum, how much was the depreciation? So you can initially take the cost over here. The cost of this one, it was like, I can take it from this question even. So this was the cost. I need to take it in the positive form, therefore let me refer it from there. This was the cost. And what was the depreciation per annum? Depreciation was tax depreciation, I would say, over the capital allowance or tax depreciation, right? This is for the purpose of computation of tax. So tax depreciation was the cost multiplied by the capital allowance. The capital allowance was 20%. So per annum you have depreciated 24 million. Now you are at the end of year 5, so therefore 1, 2, 3, 4, 5. 5 years depreciation has done. So if you are to calculate the accumulated depreciation, again it is tax, accumulated depreciation, it goes like this 24 multiplied by Fine. So there it comes, the depreciation to be 120 million. So consequently, if I'm to figure out the carrying amount, how much is that? It's cost minus the accumulated depreciation, it becomes 0. The simple thing is, at the end of the year 5, the carrying amount of this plant, as per the tax guidelines, it is 0. It is 0 because you have allowed the capital allowance of 24 million per annum. So at the end of the 5th year, you would have obtained all that benefit, then this would have become 0. Then if you can sell this 0 value plant for 12 million, there you are making a benefit. So therefore your profit, there's a taxable profit. There's a taxable profit of how much? It is like 12 million. So the tax you can compute on that. It is going to be, the tax rate is 30%. So you can see 3.6 million tax has to be paid. So this is the tax you should pay, right? Here what you can do, you can take it. So I have simply worked this out manually. That is just to help your understanding. Now you can do it in a more comprehensive way. So here how we can take it. So you have to consider the sales proceed. So therefore I would make a reference over here. The sales proceed is taken. Thereafter you need to take the, what you call, the carrying amount. Then how do you take the carrying amount? It is, initially you would get the cost B3, sorry, then you need to deduct the depreciation, in fact the accumulated depreciation. How you would take that? Again, this particular figure multiplied by, make it constant, multiplied by the capital allowance, right? Capital allowance. So what you are doing, you are simply taking, initially you are taking the sales proceed, G20 represent the sales proceed. Thereafter you are going to take the carrying amount. So how do you take that? You take the cost minus the depreciation per annum, that is the initial investment into the capital allowance, into the number of years. The project life is given over there. You may take that 5. So just do up to that level and see what you have accomplished. Yes, there you can see, you can come into this profit figure, right? Profit figure. Then all what you have to do is simply multiply everything by a tax rate. Everything by a tax rate. So make sure to keep it minus. So therefore minus tax rate. So it comes 3.6 million. The same figure what you had got into, right? What you had got into. So why do I do it in such a comprehensive way? So rather than just taking this 12 million and multiplying it by kind of the tax rate, if that is the case, you cannot apply it to all the cases. In this particular case, we have witnessed that at the end of the project life, the carrying amount had become 0. What if the carrying amount had not become 0? Right? In that particular case, if you simply take the sales proceed and multiply it by the tax rate, the answer would be wrong. So that's why I did it more comprehensively. Now, whatever the change I would make over here, it should reflect here. Right? So කෙනෙක්ට හිතෙන්න පුළුවන් දැන් මෙතන අවසාන වශයෙන් 3.6 මිලියන් ඒක අපිට ගන්න තිබුණා නේද මේ sales proceed එක අරගෙන එකෙන් කෙලින්ම multiply කරනවා 30% දාලා. එතකොට එන්නේ මෙයාගේ. ඒතකොට මේ අවස්ථාවට නම් ඒක හරි. එහෙම නිවැරදි උත්තරය ලැබෙන්නේ මොකද? carrying amount එක අපි දැක්ක අවුරුදු 5 අවසානයේ 0 වෙලා තිබ්බා. එතකොට එහෙම නොවන අවස්ථා තියෙන්න පුළුවන්. උදාහරණයක් විදිහට අපි මෙතන හිතමු capital allowance එක 20% නැතුව 15% වගේ තිබ්බා කියලා. එතකොට මෙන්න මේ වගේ තත්ත්වයක් තමයි තියෙන්නේ. right? capital allowance එක 15% තිබුණා නම් අපි මේ තත්ත්වය work out කරලා බැලුවොත් එතන cost එක තියෙනවා tax depreciation per annum K22, yes, that is into, yes, right. එතකොට අපිට පේනවා ඔන්න tax depreciation 18 million වෙනවා අවුරුද්දකට. එතකොට අවුරුදු 5ට 90යි. අවුරුදු 5 අවසානයේ carrying amount එක 30ක් වෙනවා. එතකොට 30යි 12යි අතර වෙනස අන්න තියෙනවා ඇත්තටම අපේ loss එකක් තියෙනවා. ඒ loss එක අපි multiply කරොත් B13 ඒක benefit එකක් වෙන්න ඕනේ. It comes as minus figure. Let me check that. This is multiplied by B13. What is that? This is supposed to be a positive figure, no? Because it's a benefit, kind of benefit, because it's a turnaround to be a loss equal this one multiplied by 30%. Yes, we have to convert into positive because this figure has comes as a -1. Yes, no problem with that. Earlier what we have to make sure that it's minus. Yes, it turn around to be a benefit. It must be a benefit, right? So here you can see the situation, right? The new circumstance has got accommodated. So once you change the things over here, whatever change that you did earlier, here it has comes into the picture. So here if you make it again back to the original scenario, see, so it comes perfectly accommodate the scenario. So if it become 15%, then make 15% උනා නම් අපි දන්නවා එතන අවුරුදු 5 අවසන් වෙනකොට මේ වත්කම් මුළුමනින්ම ඩිප්‍රීෂিয়েට් වෙලා තියෙන්නේ නැහැ. ඒක මිලියන 90යි ඩිප්‍රීෂিয়েට් වෙන්නේ. නිසා කැරියින් amount එක තියෙනවා 30ක්. 30ක් වටින එක තමයි 12ට විකුණන්නේ. එතකොට loss එකක් තියෙන්නේ 18ක්. ඒක මත අපිට tax saving එකක් තමයි එන්නේ. එතකොට මේක taxable profit එක loss එකක් තියෙන්නේ. profit එකක් loss එකක් මේ විදිහට identify කරන්නේ. එතකොට මෙතන tax එකක් තියෙන්නත් පුළුවන්. එතකොට tax saving එකක් තියෙන්නත් පුළුවන්. Tax can be there. If it is a tax, it should come within the bracket. Otherwise, it's a tax saving. That's why I got into that. So it should be clear to you now, right? Now you can take the net cash flow. The net cash flow can easily be taken. Now you have considered everything, scrap value, the corporate tax rate, everything has been considered. Get into the net cash flow. Take simple summation, considering year 0 cash flows. You may simply drag it. This is it. You have considered everything. Now you can get the NPV easily. Go to the formula NPV. The rate has to be specified, the discount rate. It is given like cost of capital 15%, make it constant. And the values, you can take these values. Make sure that you are not going to take the year 0 cash flow, but the rest. Having taken rest, carefully you need to add the year 0. And you may get into that. This is the situation. It generates us 2,626 and 012. 2.62 million, right? Then the IRR should be, can easily calculate, the IRR should be greater than the cost of capital. So if you take all the values here, and it says us it generates roughly 15.80. So that is the return what it generates. Now this is the format what you must follow in case of your examination. So because this gives you an easy way out. So rather than taking the working of the taxable profit as a separate thing, so considering even the non-cash flows, so it would take additional time. So therefore better considering all the cash flows, compute the corporate tax, then you better compute the tax saving on the capital elements. And finally, consider about the tax on gain or loss on disposal of the investment. So this is the easy way out, and you may get used to this. So with that, we will finish the discussion about the NPV function and the IRR function.